Good morning, everybody. It's Tuesday, 1st of April, 2025, All Fools Day. However, I'm not going to play any pranks on you today. Business is too serious. So let's get started. And as usual, I'm going to look at the market, some stock picks, and what's happening around the clubs. A couple of unusual things in today. I'm going to look at a put credit trade, and I'm going to look at an alternative to some of the normal trading that we've been doing of late. So keep listening right through. First of all, the market. And you're looking at two screenshots, so a week ago and today. And we can see that last week we had an uptick. So we'd had a 10% fall and a 3% recovery. And that turned out to be a reverse J that reversed on us. And yesterday wasn't looking so good, but at the end of the day, things rallied and we had a bit of an increase back towards at least some of that 3% recovery. And I think that was probably as a result of the interview going on with Donald Trump regarding tariffs and a wide range of other things. So things remain very volatile, and we just got to treat things accordingly. That said, we do seem to have reached a point of support. Whether that will hold, though, is another question altogether. And the clubs. So, first of all, a quick look at the outcome for March. And you can see that on this first set of clubs, Diamond, Fortune, Tees, and Sapphire, everything basically went okay. We had one stock put to us, which was Match, and that was in Fortune. That managed to get through because they put it to us early. However, it did some dilution, and it was also a profitable trade in its own right. The put premium of $7.14 per share was enough to cover the gap between the strike price and the actual price. So that was okay. Uh, some good numbers there. I mean, Sapphire with 15,000 of profits. So these are really helping to bolster the accounts in the face of some rather, falling forlorn share prices. Here are the other clubs. We had one stock put to us that was in Hain, and that was an overall loss, but it was basically $2,000 on $1 million account. And the reason I let it come through rather than rolling it forward was the $5 strike price compares very well to existing stock that's held, and the cost of taking them in was only 15,000. So I decided that the dollar cost averaging benefit was greater than that of rolling it forward. Everything else okay, and 100th millionaire with a winner this month with nearly $16,500 of income created from the sale of puts. I'm going to go back to the clubs in a moment, but I just need to go forward a bit to this week's picks. And the outcome is unusual. So I've been looking for stocks primarily that have good charts and indicators, that get a good report from Better Investing, have Zacks ratings of 1, 2, or 3, positive value line comments, decent put premium availability, don't use too much stock buying power, and have a very high annualized return on investment as far as the put premium is concerned. And I prefer end of month, start of month expiration dates, and I like to have a good clearance. That's the amount of money that the strike price is below the current price. It wasn't such a good outcome this week. There are plenty of stocks, and some of them with annual returns that are up there. There's only one over 100 this week, DXCM. But most of them, you can see the red at the side, that is earnings dates. And in most of the cases, the earnings date falls before, that's the next earnings date, falls before the May expiration date that I wanted to use for the trades. There are a couple of exceptions. One is Etsy, which I'm always a bit wary of. And the other one is Nice, which all of the clubs currently have. But there may be some scope for topping up on those. So that gives me a bit of a problem. In some of the clubs, we've got quite a lot of buying power, and I don't want to leave it lying around unused. So let's just go back to look at the clubs. And in particular, I'm going to use an example from Diamond Club. And here it is. So what we're looking at, these are all of the stocks currently held as stocks by Diamond. I can see the ticker symbols, how many shares they've got. Some are pretty low, but nearly 25,000 shares overall. What we've paid, what the current price is, where I've got a target, and they often need revising, a target get out price. I've got the cost, any income that we've actually secured on them, and the exposure. And then I've got the gain or loss on those stocks per share. And I've ordered this list in terms of the most profitable down to the least profitable. You can see Spotify is crazily profitable. We won't get all of it because we've sold a call on it, but nonetheless, we paid $135 for the 200 shares each, and they're currently $550. So we're going to get a good return on that thing. However, the ranking takes us down to the area that I'm more interested in. That's the ones that are losing. And we've got, I think it's half of them, 11 out of 22. Now that's no surprise because we're in a situation with this 10% reduction in stock values. And quite often the loss incurred is less than 10%. So we're not doing that badly. However, because we've got stock buying power available and because we've got all of those close earnings dates, I'm going to have a look instead, or at least as well as, diluting, dollar cost averaging some of the stocks we've already got to help them along a bit. And I can just start in reverse order. So one of the things I've been looking at is what sort of proportion of the account do these stocks currently make up? And I'm using sort of 5% as a preferred but not cast iron upper limit. And the 5% I always find interesting. I don't normally take 5% of the net liquid value. What I'm taking 5% of is the value of the shares that we own plus the cash. And that is around 41,000. Incidentally, you can see the value of the shares that this account has is nearly $750,000, and the exposure on them is under $700,000. So we have some good stuff in there. So I'm looking at the total value column, which is this one here, and I'm comparing it to that 41,000. So if I look, for example, at well, I won't take ST first. Let's just take one in the middle here, any old one. So we've got AKAM with $6 underwater. Uh, they're currently valued at $25,000. We're exposed at 30,000. So we've got this gap, about 5,000-ish. So that is a candidate. I've got around $15,000 worth of headroom that we could own more value of this stock. And therefore, if the runes are right, it's something I could top up to the value of 15,000. Now we've got one where there is no scope in that respect for topping up, and that's ST. And ST is our biggest loser here, $12 a share. So I've got a couple of things I could do with it. One is ignore that upper limit of 41,000 and just take it up a bit. I'm not averse to doing that. And another one would be to sell the stock and then to replace it with a new put at a lower strike price than we originally had. So the original strike, it must have been done several. There's an average original strike price of $41.18. And the current price is only 24. So I could sell them for 24 and see if I can get a credit by selling a new put for a lower strike price than 41.18. So that's the sort of thing I would be doing. So there are things we can do. The other things are there's not much scope in where we are at the present for selling calls. I only like to sell calls where we can potentially get out of the stock at a higher price than we went in. I can see one there, TAP, and I would imagine I've already got a call on it. But on that one, we paid $60. Current is 60.87. We're only exposed at 51.61. We've had $8 of income. I could well imagine we could add to that. So that's the trading that I'm going to be looking at this week. I will look at the couple of stocks that don't have close by earnings dates, and then I'll use remaining capacity to do some work on these. So given the reduction in the S&P that we've got, I thought there may well be scope to put a put credit spread trade in place on the S&P 500, and that would be on the S&P 500 index. So it would be an SPX trade as opposed to effectively the ETF of the S&P 500, which would be a SPY. That would involve buying shares in the ETF, which would in turn involve a tax. If we go for the SPY, it's purely cash involved, whatever happens, and we avoid that tax, I think. So the idea would be to sell a put, and that put would be sort of at or above the current value of the S&P 500 index, and then to buy a lower put, lower strike price put, the same number of contracts and the same expiration date. There would be a difference between the two. So I would be looking to get a higher premium than the lower premium that's going to cost me, and that would be my maximum profit. If the index fell below that lower strike price, then I would find myself in a loss, but the maximum loss would be the difference in the strike prices plus a premium from leg one times the number of contracts. The margin requirement is very low, and that's part of the attraction because the margin would be based on the difference between the two strike prices. So it would use a lot. However, unfortunately, because the VIX is showing that volatility is not as high as it might be in this at least, then the premiums that I'm getting are just not worth it. I would have to go out a long, long time to get anywhere with it. Because I'm going out on both the leg one and leg two, the difference is just not there. So I'll keep an eye on it, and if things change as volatility moves about, I'll have a go at it. Now, last week I talked about a succession plan. I'm looking for just a handful of enthusiastic, reliable people. They don't necessarily have to be under the age of 50, but there's no point in replacing me with a 70 or 80-year-old, is there? So yeah, definitely prefer it a little bit younger. I want to train these people and work with them, and hopefully one or more of them will become successful traders, capable and willing to assist me, even to inherit what I do. But the key point here is this is not just about training people to trade so they can go off and trade. I am specifically looking for people who want to work for the long term in supporting the clubs and eventually in earning a very good income from doing so. They've got to be able to stand up and train others. They've got to be able to trade, and they've got to be very, very reliable. I can't have them sort of, I don't feel well today. I couldn't make the meeting. I was this, that, or the other. Obviously, people have holidays, people get ill, and so on, but I do need a good level of resilience. Now, 3 people have stepped forward so far, and I'm putting it out there this week to see if anybody else is interested. If you are, drop me a WhatsApp message, and I'm looking to have a meeting with those involved or those who want to be involved on Thursday, the 3rd of April at 7 p.m. UK. that's the time. I'm willing to answer any questions you've got in WhatsApp messages before then, but this is the time to discuss it and to decide, see what's involved, and to make sure that you've got the interest that you initially had. And if all goes well there, we will crack on with a weekly meeting to get the training going and to get the assistance with the preparation of trades and the filling in of trading records going. So if you're interested, drop me personally a WhatsApp message. The Facebook group is still up there and running. If you're not in it already, please join the Extraordinary Stock Trading System. And if you're not in an investment club, an extraordinary investment club already, then have a look at myinvestmentclub.co.uk. You can put in £100 a month, you can put in 100,000, you can put in really what you want. And we hope to do significantly better than that. Find out a lot more at the website, ask me questions, ask if you can join the WhatsApp groups of a club, and ask the members directly what they think of it. That's about it for today. Have a good week.